It is a new year, and I am considering adding a new dividend stock to my portfolio. That is right. I am considering adding position number 44 to my dividend stock portfolio. If you've been following my channel for a while, you know I have one sector where I'm really underweight, and that is the financial services sector, and in particular, the large mega US banking sector. I own an insurance company called Chubb. This is a property and casualty insurance company. I started building my position recently, last year. I own a small U.S. regional bank called Bank of Hawaii, and I own a larger bank in Canada called Bank of Montreal. But when you sum up all of these financial sector investments I have, it's a very small percentage of my portfolio, and I am lacking a major U.S. bank. And so I thought, hey, it's a new year. There's nothing that motivates me more to deploy money to the stock market than building up new positions. And I also have this theme right now. I have this theme in 2020 that I've shared with you recently that I want high yielding stocks. And I want high yielding stocks that are attractively priced because I want current cash flow. And so it got me thinking, Ian, there just so happens to be a high yielding stock right now in the U.S. stock market, large U.S. bank that is attractively priced, and that stock is Wells Fargo. And so I am going to analyze Wells Fargo today, but I'm also going to compare it. I'm going to compare it to some other large U.S. banks, Bank of America, and also JP Morgan Chase, and I'm going to look at all of the financial metrics. I'm also going to compare it to Bank of Montreal as well, because I think it gives a really interesting comparison. And sometimes when you're thinking of adding a new position like myself, you want to look, would it make sense to add a new position, or would it make sense just to add to an existing position? And so I'm going to do an exhaustive financial analysis today. This is a long-time subscriber request. Ian, how do you analyze banks? I'm going to share that with you in today's video. I have a lot of metrics to go through. It's going to be a really exciting video. I know a lot of subscribers have been waiting a long time for this, and I'm going to also explain my thought process, how I'm thinking about this. Should I really be adding another position or not? Is it just going to clutter up the portfolio, or is it going to be compelling to add another position? We will find out by the end of today's video. So get ready. It's going to be an exciting video, everyone. So before we get into anything, why am I even thinking of adding another position, another bank stock? It really just hit me the other day. Sometimes stuff just comes to you as an investor. And I was thinking, especially as a real estate professional, that banking really powers everything. Banks are kind of the cornerstone of the economy. Without banks, there aren't loans. And without loans, businesses cannot work. Businesses cannot operate. Most businesses out there, they take on loans and they use that capital to build something great. And without that, how does the economy perpetuate? It doesn't. And then I started thinking, hey, the way these banks kind of work is they're quasi-government agencies, kind of like regulated electric utilities, for example, which I love so much. The governments rely on these banks because without these banks, the economy will not grow. It will not propagate into the future. And we all know from the 2008 financial crisis that these banks will work with the government when a situation happens, when an unfortunate situation happens, these banks actually will be bailed out. And so I start thinking these banks, they're kind of like an extension of the government in some ways. And I like investing in those kind of sectors because we know when stuff is regulated, it's just hard to be disrupted. It's difficult to be disrupted. It's difficult for a new bank to suddenly emerge, for example, and completely displace Wells Fargo out of business. And in many ways, there's parallels to regulated utilities. I like those kind of sectors because they're defensible. And so I just start thinking, I've been ignoring this sector. One of the reasons I've been ignoring the sector is, quite frankly, I didn't want to, at the time at least, deviate too much from my bread and butter consumer non-cyclical strategy. I'm really good at analyzing those stocks. I know a lot about those stocks. And so shifting over to the banking sector, it kind of involved a re-education of sorts. It's a whole different type of financial analysis. It's very different than analyzing a consumer non-cyclical stock. And so sometimes for me, at least, and I imagine for a lot of you at home, it's easy to get caught up in one type of investing and kind of dive really deep into that and to become an expert in that and to ignore sometimes other sectors. But it's a new year. And I started thinking, Ian, you got to get over this mental roadblock. You got to get over this hurdle. You just got to analyze the bank stocks and at least educate yourself on these banks and then figure out if it makes sense to add a new position to your portfolio. And so I just went for it. And this is just a take home for everyone at home. If you are an investor, you kind of have a roadblock or a mental roadblock, you're thinking about something in 2020, should you do it or not? Just go for it, at least do the analysis, and that's what I did. And so I want to pop on the screen right now a summary. This is a summary of all of the banks that I analyzed, and I'm going to go through some very basic statistics first, and then I'm going to dive into a lot of bank-specific ratios and analysis because analyzing a bank is very different than analyzing a consumer non-cyclical company, for example. And so let's dive into this right now. You can see here Wells Fargo, Bank of America, JP Morgan Chase, Bank of Montreal, Bank of Hawaii are in this summary. By the way, as I go further on in the video, I'm kind of pushing Bank of Hawaii out of it just because it's a different type of bank. It's a very small regional bank. But in the summary here, I want to include it. And so you see just the standard metrics I always look at here on my channel: price per share, dividends, dividend yields. I'll start with the dividend yield. I invest for cash flow. My goals revolve around high current yield, undervalued stocks, value stocks. And so I gravitate very naturally to the two that I highlight here, Wells Fargo and also Bank of Montreal, because out of the group, they have the highest yield. And in fact, Bank of Montreal has the highest. It gets me thinking, Ian, should you even add one of these big US banks, such as Wells Fargo? Or is it better just to add more capital to Bank of Montreal? By the way, I recently did a video with my top stocks I'm looking to purchase in 2020 because of their high yields and because of many other factors. Bank of Montreal didn't quite make the list, but after the analysis I'm going to share with you today, it's kind of back on the list. I discounted it a bit, mainly because I already have a large weighting in it, larger than I want. That being said, after the analysis today, perhaps I will buy a little BMO in 2020. We shall see. Anyways, dividend yield is the highest at BMO. Last dividend increase, you start looking at these across the board, and Bank of America had the highest. Bank of Montreal and Bank of Hawaii have the lowest, but mind you, both of those numbers can basically be doubled. That's why I have the stars next to them, because they raised dividends twice in 2019. And so, but there's even doubling those dividend increases, it's still the lowest of the bunch. That being said, I want to be really transparent here. Wells Fargo, Bank of America, JP Morgan Chase, these are organizations that cut their dividends during the financial crisis. And so, yeah, the dividends are increasing now really quickly for them. Oh, it looks great. But you know what? That's just because they're starting from a very low point. And so when you look at these dividend increases, I highlight Bank of America, but quite frankly, should it be highlighted? Should anything be highlighted here? Probably not. When I look back in time at Bank of Montreal, for example, they did not have to cut the dividend during the financial crisis. They weathered the storm, and they outperformed from a dividend investor's standpoint on that metric quite handsomely because Wells Fargo, B of A, JP Morgan Chase, they faced substantial turmoil during the financial crisis, and it affected the dividends. And so moving on, compound annual growth rate, again, for the dividend, it's the highest at Bank of America. But again, it's really easy to be the highest when you're starting from nothing because you cut the dividend because you're mismanaging your bank. And so that is something to really think of for me and for you at home, just very strategically. If you're investing in the banking sector, do you even want to touch it as a dividend investor? Because all of these guys are guilty of cutting their dividends and they're guilty of mismanaging their banks in this subprime crisis. And so very, very important nuance. I kind of look at it philosophically that the crisis was bad. They had to cut the dividends. But looking forward, the crisis changed banking policy in the United States, and it probably has set these banks up for future success and for better stability going forward. We'll talk about that in the future. You'll see this later in the video when I talk about leverage quite a bit, because the US banks, as compared to Canadian banks, for example, are less leveraged now. They're under leverage, and they're under leverage, or I shouldn't say under, but they're quite substantially less leveraged than Canadian banks because of new policy in the United States as it pertains to leverage, and that creates more security for investors. And so I kind of look at it, yeah, financial crisis was bad. Definitely wouldn't want to own the banks going into it, and the banks in many ways fueled the crisis. That being said, after the crisis, is it a blessing in disguise going forward for future dividend investors like myself buying the stocks post-crisis because there's new policies that make the stocks better? Just a thought. Anyways, dividend increases here I largely discount. And quite frankly, I probably highlight the wrong thing highlighting B of A. Probably should have highlighted my Bank of Montreal, Bank of Hawaii. To my understanding, I didn't look at Bank of Hawaii, but I don't think they cut the dividend during the crisis. I know BMO didn't because I looked at that one. Moving on, in terms of 2019 and 2020 EPS estimates from the analysts and PE ratios, all of these look to be reasonably priced. This is why I'm looking at these actually. This is why I had kind of this epiphany, is that, Ian, you want high yield in 2020. You need it. You want current cash flow. Ian, you like to buy value. Different sectors trade at different ranges historically. Banking stocks are always kind of lower PE stocks. That being said, even though it's a lower PE industry by nature, these stocks are trading really attractively right now. So like Wells Fargo's at an 11.8, JP Morgan Chase, Bank of America in the 13s. Bank of Montreal is the lowest PE at 11.38, and at 2020 it's at a 10. So again, props to Bank of Montreal. Before I made the judgment in my last video, or one of my recent videos, not to include it on my list this year, I probably made that judgment a little too quick based on allocation. There's a lot you'll see in the video today that makes me rethink for Bank of Montreal. Probably get that back on the list, buy some shares in 2020. And payout ratios on all of these look attractive. They're all under 50%, especially attractive at Bank of America. But again, Bank of America, you cut your dividends so much. Of course, your payout ratio is low. Of course, the growth rate is high. You cut the thing basically to nothing. And market cap, you'll see here, I highlight Wells Fargo because I like it. It's a big guy, $227 billion, but it's not too big. There's room for growth. And certainly it's bigger than the $49 billion market cap of BMO and the $3.8 billion of Bank of Hawaii. And so, again, what I'm trying to illustrate with market cap is the whole purpose for this, the whole purpose of even looking at banking stocks here, is there's this niche in my portfolio from a diversification standpoint that I lack. And it's the large US bank. And you see that through the market caps here. These guys are big and they're only getting bigger. Quasi-government agencies not going away, and there's not a newcomer coming into the mix. So that's one reason to like these types of companies. Same goes for Canada as well. There's the big banks in Canada. There isn't going to be some newcomer come in and displace them. And so something interesting about the banking sector. Okay, so now that we went over just the high level stuff, as you can see out of these, I'm naturally gravitating towards BMO and Wells Fargo. BMO I already own, and Wells Fargo because I'm a dividend investor. And I'm not really looking right now to buy stocks that are, one, fairly valued. I prefer to buy stuff on discount. Out of all of these, Wells Fargo and BMO have the lowest PEs. Also, I'm looking to buy stocks with high current yield. I'm not looking for stocks that grow. Well, I'm certainly looking for growth, dividend growth stocks as well. But for 2020, my focus is more so on high current yield than anything else. That's just my strategic focus for 2020. And so obviously I'm gravitating towards those two names. And so I want to go on now and I want to share how I am analyzing these banking stocks. I look at a lot of stuff, a lot of different metrics, and a lot of this, quite frankly, was inspired. It was inspired by internet research. There was a Motley Fool article in particular, so props, shout out to Motley Fool, that helped educate me on how to look at banking stocks. And so I learned a lot by doing this analysis. And quite frankly, what I'm trying to share is even a seasoned investor like myself, 20 plus years of investing, big portfolio, 43 stocks, I have stuff to learn. I have a lot to learn. And certain sectors of stocks I know all about. Consumer non-cyclicals, electric regulated utilities. But you guys know there's pharmaceuticals. You know, there's certain sectors that I'm newer to. One of them is insurance. And so I really got myself up to speed on the insurance sector in 2019. And this year, 2020, it just came to me. This wasn't even a goal of mine, but I'm starting to bring myself up to speed on the banking sector more so than ever before. And how am I doing it? I'm doing it just through research like any of you at home can do. And so I want you to rest assured that I don't really have some huge competitive advantage. Yeah, I have the experience that I've been investing for a long time and I can bring parallels from other industries, but I'm still learning as well. And in banking sector, I'm learning just like the rest of you. And so hopefully that's a nugget of inspiration that you can take home that quite frankly, we're all on equal footing here in this amazing community. And so in props to Motley Fool for all of the great online education as it pertains to banking stocks. So I want to pop a bunch of stuff on the screen here. I'm going to start with my first analysis, and this one is going to be loans to assets. And so the reason one wants to look at loans versus assets, first and foremost, these are loans. These are loans typically, I would say, real estate centric, although different banks have different types of loans they make. They're making business loans, they're making real estate loans. I didn't get into that level of analysis here. I'm just looking at high level loans. But as many of you know, these banks in the US, especially the big ones, they can be in many different lines of business. Perhaps they own a stock brokerage type of business and they earn money through commissions. Perhaps they do high net worth wealth management. They earn commissions through that. Perhaps they do strategic trust planning and they earn money through that. There's all kinds of things that banks can do to earn money. But for me, you may remember when I did my Chubb analysis, I'll link to this in the description below. The reason I selected Chubb, one of the big reasons as my insurance company for my portfolio, I wanted an insurance company. I looked at a lot of them. I selected Chubb. Is because I wanted a pure play. I wanted a pure play that was really focused on property and casualty insurance. I wanted the pure play. Banking, it's kind of the same thing. I don't want some big conglomerate that does it all. Unfortunately, that's how they all are these days. But I wanted out of those big guys to find the one that was mostly a pure play on loans. Because how do banks traditionally earn money? The way they traditionally earn money is they bring in deposits. Those are liabilities for the bank. They leverage those deposits to loan out money at a higher interest rate, and they make money on the spread. And so that's kind of the classical savings and loan model, if you will. And so just as I wanted the classical kind of pure play insurance company, as much as possible, I would like to have a bank that kind of follows the classical structure, because I think all these other ancillary businesses, they sometimes can make it harder, more difficult for an investor to analyze the bank, and they can just create more risk for the bank. I think the least risky thing the bank can do is take in deposits, pay a nominal interest rate, leverage up those deposits, and loan out money at a higher interest rate and make the spread. That is the best way, in my opinion, the safest way a bank can make money, as long as the loans are not overly risky. Obviously, during the subprime crisis, they were too risky and caused all kinds of problems. Okay, and so what you do is you look at loans to assets. You literally look, okay, the bank is claiming they have all these assets. Of all of those assets, what percentage do loans comprise? And so loans are assets to the bank. And so if you look at Wells Fargo, they've got $943 billion worth of loans, but they're claiming $1.89 trillion in assets. And so loans make up about 50% of the assets. And so Bank of America, loans are only 40% of assets. JP Morgan, boy, loans are only 37% of assets. Bank of Montreal, 50%. And so off the bat, for me at least, I like Wells Fargo again and Bank of Montreal here because these are banks focused around traditional savings and loan model, at least for half their business. I'd like to see it up even higher, but at least for half, whereas a lot of these companies, Bank of America, JP Morgan Chase, less than half of their assets are loans. And so I like to focus on companies that are kind of the traditional bread and butter banking model. Okay, and so there's two more metrics here that kind of give a flavor as well. I'm going to pop this on the screen that share kind of how core are loans to the business. Again, because we're still in this frame of mind, just trying to think, how does the bank make money? Is it a loan-centric bank? Well, what we can do is we can look at deposits. Deposits for the bank, mind you, are liabilities. This is money, for example, that I deposit at the bank. Again, the bank levers it up, loans it out, and earns interest on the loan and makes money on the spread. And so we just start looking like, let's look at deposits, because without deposits, the bank is not making loans. Those deposits are the lifeblood of the bank. We'll get more to this later, because one of the things that scares me of Wells Fargo, our deposits are going down. I think some of that is because of just a lot of recent drama around Wells Fargo last few years. One of them, there's this whole fake account scandal I was reading about. And so that's a risk, that's an issue. But let's look at this. And so deposits, by the way, we also want to just look at overall liabilities of the bank. Again, deposits are a liability. What some analysts argue is that the higher the ratio of deposits to liabilities, the better, because it means, again, it's a pure play standard savings and loan bank, traditional model. They're bringing in a lot of deposits. They're levering it up, loaning it out as loans. And so you look at deposits as a function of liabilities, it's the highest at Wells Fargo. That's why I highlighted. I like that. And you look at loans as a function of deposits, it's the highest actually at Bank of Montreal, then second highest at Wells Fargo. And so again, it doesn't mean that JP Morgan Chase is bad. We're going to get to some stuff later how it's really good. It doesn't mean Bank of America is bad. We'll get to some stuff later how it's really good. But it just shows for someone like myself who wants that traditional pure play model, kind of like I did with Chubb in insurance and banking, I'm thinking, hey, I just want to stick with the bread and butter savings and loan model. You can kind of see these metrics illustrate that. By the way, I'm going to link to my spreadsheet in the description below so that you can just download it if you want to follow along at home. As always, just want to share my best content here for free on YouTube. So I hope you enjoy it. And if you do enjoy that spreadsheet or this video, I please ask you to subscribe. It is the best New Year's gift you can give this thug life investor. And so anyways, thank you, by the way, for everyone who's purchased the merch out there. The merch has done really well recently. A lot of folks bought it as holiday gifts, but think about it. Consider purchasing yourself a New Year's gift. It's 2020. You want to motivate yourself or a loved one or a friend to be the best possible dividend investor. Do not forget that I now offer custom dividend investing merch for all the Thug Life investors out there. And I will link to that in the description below as well. Okay, so I want to move on and I want to start looking at another metric. I'm just going to pop all of this on the screen for you guys as I go so we can follow along at home. But here's something that concerns me. So I wanted just to look, Ian, deposits. This is the lifeblood of the bank. The bank attracts people to deposit their money. It's a liability for the bank, but the bank can lever it up, and the bank can use those deposits then levered up to loan out money. And when the bank loans out money and it earns a higher interest rate on the loans than it pays on the deposits, the bank earns money. And that's how the bank works. And so I start thinking, Ian, it's really good if the bank can increase deposits. And then I start looking 2017 versus 18. Okay, deposits are down at Wells Fargo. That ain't good. But deposits are up. Bank of America at 5.5%. They're up nominally at JP Morgan Chase, but better than down. And they're up the most at BMO. So go BMO, company I already own. Like I said, sometimes doing this analysis, it gives a newfound respect for companies you already own. This gave me a newfound respect for BMO. So I was really, really happy to see that. And so this is a red flag for Wells Fargo. That being said, I'll give a nuanced point here. Oftentimes, I like to invest in great companies, world-class brands, when not everything is firing on all cylinders. Because if everything is firing on all cylinders, the PE of Wells Fargo wouldn't be an 11, it would be a 13, like it is at Bank of America and JP Morgan Chase. But the reason it's trading at a lower PE is Wells Fargo has some issues here. It's facing some drama. It's facing some challenge. Why are deposits down? In my opinion, it's because of some of the scandals in recent years. And one of the scandals I was reading about again, there were like employees opening fake accounts and such to try to make themselves look better at the company. And so that is not good. I think the negative press has gotten out there. There's probably folks who have moved deposits elsewhere. And quite frankly, I'll tell you, JP Morgan Chase has done a phenomenal job with their marketing, with their direct mail. If you live in the United States, I have to imagine you have probably received in the mail at one time or another, if not 20 or 30 times, or if not 100 times at this point, this little thing that says, hey, get $300 free if you open an account and deposit X amount of money. I bet you that strategy at JP Morgan Chase has attracted clients away from Wells Fargo. And so what I'm trying to say here is, yeah, it ain't good that deposits are down at Wells Fargo, but could it be because of this that it creates just enough issue, just enough drama that it's not catastrophic to a long-term investor, but it creates a short-term entry point, a buying opportunity? And so I kind of look at this nuanced, and I almost look at it as a good thing from a stock entry standpoint. Okay, so one thing as well is, again, banks earn money different ways. They earn it on fees, they earn it on interest income, and so a lot of bank financial reporting on the income statement, it will reflect where's the revenue coming. Is it coming from interest income or is it coming from non-interest income? And in general, the theory that I am taking into this analysis is, again, I want the pure play bank, the traditional savings and loan model. None of these are, but as much as I can get it, I want it. And so I want the bank that's earning a lot of money from the net interest income, because net interest income, net, by the way, means it's after allowance for losses. So these banks will carry on their books an allowance for bad loans, for losses. And so net interest income, it's after that. And that as a percentage of total revenue of net interest income plus the non-interest income, the higher the better, because it shows that the bank is making money from interest on loans. And so anyways, on the overall revenue at Wells Fargo, it comes in the best. At 57% of their revenue is coming in from net interest income. And so you can see here, the net interest income is a whopping $48 billion. And it's only surpassed in raw dollar terms at JP Morgan Chase just because it's a lot larger of a bank. Okay, and so a lot of investors ask me here on my channel all the time about book value. What is book value? It's assets minus liabilities. Another way of looking at book value, or another name for it, is shareholders' equity or stockholders' equity. It literally indicates what is left of the pie, what's left for shareholders if the company were to dissolve instantaneously. As it pertains to consumer non-cyclical companies, I don't really care about book value at all, because these companies pay out most of their cash. They want to get it off of their books, and they want to get it to shareholders. And it's a different type of model. They have a lot of intellectual property. They have a secret sauce as it pertains to whatever widget they build. They have a brand they've established. They sell that brand. They make money. And so book value, quite frankly, to me, doesn't mean a lot for consumer non-cyclical. But when you think about a bank or an insurance company, it means a lot. Because you start thinking, at the end of the day, does the bank's kind of brand name matter that much? Are they, maybe a little, but are they producing a secret sauce or a secret widget? No, not at all. They're literally taking in deposits. Those become their liabilities. They're making loans, those become their assets, and they're earning money on the delta. And so anyone can do this. It just so happens that the reason these banks are in existence is they have the history, they have those relationships with the government, they become really big, they're going to be hard to be displaced, all that good stuff. But there's no real secret sauce here, in my opinion. Sure, there's some company culture and some goodwill, this and that. But all I'm saying is this is an industry where book value really matters, just like with insurance companies. And book value also is indicative of how well operated is the bank, how good is their underwriting, how well are they managing their operations. So I wanted to look at book value for these companies, but I also wanted to look at the price to book. How much above book value are they trading? Because it gives an indication of value. And in this sector, I like to buy stocks as close to book value as possible. And so I started looking, what is the book value? You start seeing here for Wells Fargo, it's $197 billion. You start looking for some of the other banks, different numbers. And so how does the price compare to the book? How is the aggregate market value of all the stock compared to the book? Well, Wells Fargo, it's trading just above book value. It's trading at 115% of book value. And so it's trading, in other words, 15% above book value. That's pretty good. Bank of America, not too much more, so pretty good. JP Morgan Chase trading well above book value, so that's a red flag for JP Morgan Chase. BMO, best of the bunch. It's basically trading at book value, only 7% higher. And so that being said, we all know book value is deceptive. And so I started doing a further analysis and I looked into it. I wanted to really look into their assets. What are questionable assets that they carry? And so goodwill, worthless. I just wipe it out. We all know with Wells Fargo, for example, why are deposits going down? Because goodwill means nothing because their brand is tarnished right now. I think they'll get it back, but it's tarnished. What else? They have derivatives. A lot of these companies, these banks are carrying derivatives on their balance sheet. I'm just assuming that these derivatives are worthless. And so I don't even know much about it. All I know is derivatives are complex financial instruments, oftentimes creating a lot of risk. And so I don't count those as assets at all. Maybe they are. Maybe they should be discounted. I just wipe them out. And so I start looking, Ian, what's the real assets here? Let's just look at the real assets. Well, I subtract them down for these questionable assets. So Wells Fargo, for example, has $37 billion in questionable assets. Bank of America has even more. Look at that. Bank of America, they're carrying their goodwill. It's $69 billion, whereas Wells Fargo is only at 26. At least Wells Fargo is not inflating their goodwill so much. This is ridiculous that Bank of America thinks their goodwill is worth $69 billion. No, it is not. And Bank of America, by example, has a huge amount of assets in these derivatives. By the way, I'm new to this. If you work at a bank or you know more about banks, I'd love you to indicate in the comments below what you think about the goodwill and the derivatives as it pertains to these banks, but I'm just basically writing it off. And so Bank of Montreal, numbers are all smaller. But what you see here is derivatives as a comparison to their overall scale of their bank. They got a lot of derivatives going on. And so that was one potential thing with Bank of Montreal that I didn't like seeing as much. Anyways, I just go down my analysis. I look at their real assets now. And I pull out liabilities as well. I just show you what are the liabilities here. I take assets, I subtract out liabilities. I get a real book value. Here's what the real book value is. And then I just start looking at what's the price to the real book? And I also start looking at percentage-wise, what's the ratio of the real book to the quote-unquote book value? Basically, what these numbers show me is that Wells Fargo is trading the best. It has the lowest price to real book value, and the ratio between the two pops up the lowest between the real book value and the book value. And so what it shows me is Wells Fargo is not playing as many games with goodwill and derivatives as some of these other banks. And what's interesting is with Bank of Montreal, this is actually a red flag. Their price to book is 107%, but their price to real book is 238. And so again, it just shows you that these guys at Bank of Montreal are carrying A huge $22 billion worth of their assets are derivatives. I would love to learn more about that. If you are an expert in the Canadian banking sector, you work at the Canadian bank, you know about these derivatives. To me, that sounds awfully risky. But again, I don't know too much about what these derivatives actually embody, what they represent. I just know that when I hear the word derivative, it sounds a little bit risky. And I would rather see the assets in the loans bucket than the derivatives bucket. And so, again, this was an eye-opener. And I start thinking, again, Ian, what are some reasons that you would add Wells Fargo? Why would you do that when you already own Bank of Montreal? I already talked about some of them, but this is one right here that on a book value standpoint, this baby is trading really close to book as far as the banks I'm analyzing here. Okay, so I want to look now at something called return on equity. This is something I looked at when I was analyzing the insurance companies as well. When I was looking at Chubb, for example. And return on equity, it's really important for banks and insurance companies. As it pertains to consumer non-cyclical, again, couldn't care less. And so another just takeaway and nuance here is analyzing different types of companies is it's an art and science to each sector. And certain principles apply to all of them, but certain ones are only reflective really of certain sectors. And return on equity, again, this is a bank-specific thing, but it shows you the equity, which is assets minus liabilities, the stockholders' equity. What kind of return are they getting on that equity? And so what they're getting is looking basically at the net income. I take the net income and I divide it by equity. You can see the return on equity here. And you can see Bank of America is the lowest return on equity. Wells Fargo, second lowest. JP Morgan's got it going on. Bank of Montreal's got it going on. That being said, you got to be careful with something like return on equity because it's also indicative of risk. Higher return on equity, higher net income as a percentage of equity. Could it be that they're goosing the net income by taking on riskier loans that have higher interest rates? And so I have to be careful with return on equity that, yeah, BMO's got it going on, JP Morgan Chase has got it going on. But just because Wells Fargo has a lower return on equity doesn't mean it's bad. It may just mean that they're being a little bit less risky than the other banks. Another metric that many people use that look at banks is this concept of net interest margin. And this is, again, very similar to the return on equity. This gives a sense of the net interest income divided by the loans. What kind of interest rate are they getting? What kind of interest rate are they getting on these loans? And so when you look at this, you take the net interest income, you divide by the loans. The U.S. banks, they're kind of all in a similar bucket. They're in the fives, but JP Morgan Chase is getting a better interest rate. They're getting the highest. But you look at Bank of Montreal, and maybe I'm doing the Bank of Montreal math funny because the reporting, it's a Canadian company. It's a little different than the U.S. ones. Maybe I made a mistake here. And so always, when you look at my analysis, do it yourself because I do make mistakes. I'm doing my best here, Thug Life style, back of envelope style, but it's the best I can do. It's at a 3%. And so you start thinking, oh, Bank of Montreal, your net interest margin, it's kind of low. What are you doing wrong? But then, as any smart investor does, you don't want to just take that at surface level. You want to look a little deeper. Well, maybe it's a function of them taking on less risky loans. And maybe when you have a less risky loan, the interest rate on the loan has to be lower to attract the best quality. And I know that Canadian banks have a history of taking on really credit-worthy loans and partners to the bank. They want people who are creditworthy. They're going to extend to them lower interest rates, but those people they're lending to are ironclad. And so I look at something like this, and honestly, it doesn't tell me one is better than the other. It just kind of, more than anything, tells me risk profile. The U.S. banks, maybe they're taking on a little more risk than the Canadian bank. That said, you'll see something later on leverage. The Canadian bank is much more leveraged. And so I'll plant the seed. What it kind of tells me is U.S. banks, lower leverage, but maybe they're taking on a little more risk with the type of people and companies they lend to. Canadian banks, a lot more leverage, but they're taking on less risk with the loans. They're lending to more credit-worthy people and companies. And so it kind of works out. You're taking on more leverage. You don't want to lever up and then have risky loans. So I think it's just a different business model, which again gives me reason. Ian, why would you want to own Wells Fargo when you already have Bank of Montreal? Well, because it's a very different type of company and it exposes my portfolio to a different, just a completely different sector of finance than I'm getting exposure to right now, which is nice when I'm building a huge portfolio that's going to weather generations into the future. All right, so I want to look at something called the efficiency ratio. This one gives a sense of how much waste is happening at the bank. And so it looks, when you look at a bank and you look at their income statement, it talks about interest-related expenses and it talks about non-interest expenses. Non-interest expenses is kind of the overhead. It's the sales, general, administrative type stuff. And what the efficiency ratio does is it just looks as a percentage of the total revenue that they're bringing in at the bank. Of that total revenue, what percentage are these non-interest related expenses or SG&A, sales, general, administrative? You can see at Wells Fargo, it's the highest of the bunch, BMO, lowest of the bunch. And so props to BMO because you're running a really efficient, tight ship, which is good. But I'll tell you again, it's a double-sided coin here because Wells Fargo, they're the least efficient. 66% of their expenses are going to SG&A, the overhead. That on surface level looks bad. They're operating a bad ship. But it goes back to my point earlier. PE of 11, highest yield of the bunch other than BMO. Highest yield, I'm talking about the U.S. Big banks that I looked at. There's some certain problems at this bank. Deposits are down. Here's another one. There's a lot of wastage. You've got a big investor in Warren Buffett. Might he come in and see a ratio like this and tell these guys to get their bank under control and to cut unnecessary expenses? When they do that, are their margins going to expand? Are they going to have an opportunity to drive more dividends for shareholders? Oh, this starts looking interesting. And so I look at something like this, quite frankly, as a positive and negative. It shows that there's actually more room at Wells Fargo for improvement than the other banks. And it kind of starts telling me the story. I'm getting in at a high yield if I decide to buy, getting in at an attractive PE if I decide to buy. There are good things about this bank. It's really focused on loans and deposits, which I like. It's got some other things going for it. I'll summarize at the end, but it's got some bad things too. And one of the bad things is its efficiency ratio is pretty awful. Maybe there's room for improvement there though, which I like. And just being a business operator myself, I know this bucket, it's not hard to improve. It's an easy bucket to improve. And so to have wastage in efficiency, just get a good CEO in there, get a good management team, figure it out, and drive more money for thug life investors like you and me. And so I like that about this company. Moving on, leverage. All right, this is one of my favorite things from this analysis. There's many ways to look at leverage, but the way I'm looking at leverage here is I'm looking at assets as compared to shareholders' equity. So again, shareholders' equity is assets minus liabilities. It's what's left. It's the book value. And then I'm just looking at all the assets. If you take assets, you divide by shareholders' equity, it gives a sense of how much leverage are they taking? How levered up are they? And so historically in the United States, my understanding is leverage used to be higher, but post-financial crisis, the regulations have been changed such that these large banks, they can't have the kind of leverage they used to. And so again, yeah, they cut dividends. Yeah, they went through hard times, but they're kind of reemerged as newer, different organizations than they were before. And again, they ain't going anywhere because the government won't allow it to. The world would collapse without these banks. These banks and this leverage is how society works. If there weren't these banks, if there wasn't these leverage, we would not be in a very good place as a society as we know it. And so for better or worse, whether you like it or not like it, it's there. It is what it is. And so you start looking at something like this, and the leverage, obviously, at these U.S. banks is a lot lower than Bank of Montreal. Bank of Montreal is in the 18s. Bank of America is the lowest at an 8.87. Bank Wells and JP Morgan all in that same range. But B of A, they're the best. I like lower leverage. And so this is probably one of the single biggest reason for me, if I were to diversify, to buy something like Wells Fargo, because I'm getting into a bank that has less leverage. The biggest finance position in the finance industry I have now is BMO. BMO got a lot of leverage. That being said, I'm going to flash this on the screen again. If you go back to the net interest margin, BMO's net interest margin is the lowest. Why is their net interest margin the lowest? Probably because the loans that they're making are less risky. And so it's kind of interesting. I think in Canada with BMO, what's happening is they're providing less risky loans, but they're levering more. Maybe that's some of that derivatives comes into play there. Maybe that's part of it, which they're carrying a lot of derivatives on their balance sheet. US, they got these higher efficiency, if you will, on your loans, but it's probably by taking on more risky loans, but they're levering less. And so they're kind of taking on different types of risk. It seems in Canada, there's more a risk of leverage. In the US, it's more of a risk of this basically net interest margin, basically the net interest income divided by the loans. And so it's just, again, indicative of a very different business model. Things are operating quite differently in Canada than in the US. But again, it's a reason for me to look at the US. And again, out of these, with the leverage standpoint, I like Wells and B of A the best. Okay, so I want to look at bad debt a little bit. Honestly, I don't even think I'm looking at this right. But one thing that, again, just disclaimer, I got to be honest with you. I'm learning as I go here. I'm newer to analyzing the banking sector. But it's a new year. And again, I can't stress this enough, so I'm going to repeat it. One of the favorite things about being an investor is I learn new skills. I learn new things. I did this analysis because it's a new year and I want to just learn new things. I want to broaden my knowledge. And sometimes in life, when you get to my stage, late 30s, you have limited free time, you have kids, you're in a job, you're in a routine. You're only learning so much on a day-to-day basis. And so if investing can open my horizons and be a gateway to learn new stuff, that honestly is probably more magical than the money I will make. Well, I guess nothing is more magical than the money as the Thug Life investor. But I just got to say, it's pretty awesome. And so use investing as a gateway to get out of that rut. Get out of that rut of not learning new knowledge. I'm using it to learn new knowledge, and I love it. And I'm going to get real big into pharma stocks this year and learn all about pharmaceuticals, medical devices, all about that world as well. And so that's what's so fun about investing. But anyways, I look at their bad debt, and I'm basically just looking at their allowance for loan loss as compared to their loans. And it's pretty similar in the U.S. It's 1% for all of them. I guess B of A gets the best. But in Bank of Montreal, it was really low. It's at 0.19%. Maybe I'm looking at BMO wrong. Or maybe it all goes back to the story that I was thinking before, is that BMO, lower interest rates on their loans, more leverage, less loans going bad. I think it's just a different model in Canada. They're taking on less risk, but they're levering it up more. Whereas in the US, they're taking on more risk. There could be more bad loans and not levering it as much. And so just very different way of doing things. Moving on, I want to look at the stock return. Again, this is a double-edged sword. There's two ways to look at this, but usually a stock that has gone up over the long term, it's indicative of a well-managed company. And good job to JP Morgan. They have the best stock return over this period of all of them. And I'm looking over basically January 1st of 2015 through January 2nd of 2020. And so we're seeing the 139% increase there. That being said, my high yielders, Wells Fargo, Bank of Montreal, you guys have gone nowhere over that time. And so that is something to keep in mind for those two companies. And so that being said, it kind of gets you thinking, is JP Morgan, it's priced at a higher PE. Is the run over with? Is it time for Wells Fargo to get past some of these issues and reemerge? And could the growth be ahead for Wells Fargo? And that gets me interested as a value investor. I kind of like it when it hasn't gone anywhere in 5 years. So like I said, it could be a bad thing, but it could also be a good thing. All right, the last thing I just want to look at, more important than stock price, is net income. Where's the net income growing the most? It's growing the most at Bank of America. It's up 52% comparing 2018 versus 2016, whereas Wells is going nowhere. It's up 2%. BMO second lowest at 14%. And so, quite frankly, this is why Wells and BMO stock is not up, is because the earnings are not up. And so again, though, could it be a point of inflection for these companies where earnings start growing? And so the way I look at all of this, just to take a step back, is I got a bunch of stocks here. Everyone's situation is different. I'm at the point where I got enough dividend growth stocks in my portfolio. I kind of want the one that pays the juicy dividend now because I want cash flow now. So I gravitate towards something like a Wells. That being said, you do this analysis, there's a lot of good things about Bank of America. There's a lot of good things about JP Morgan Chase. It's hard to say which is the best. I don't think there is one best bank. I think they are all good. Warren Buffett said he loves all the banks. He invests in a lot of banks. But I think different investors at different points in their careers who have different strategies will gravitate towards different things. Someone who wants a lower starting yield but more dividend growth doesn't need the cash flow now. They might be well served to go towards a Bank of America, for example. Someone who doesn't care about loans being as big a component of the business might go more towards a JP Morgan Chase, which is much more of a conglomerate style financial organization. And it's the biggest market cap. It's the big guy in the industry. And so there's no one right answer here. But for me, wanting to have the current yield, wanting to have the value, wanting to buy something that's a little distressed, it has some drama, so I'm getting it at a value, wanting to have something that's kind of lower leverage, a little bit lower risk, I gravitate towards something like a Wells. And so one thing worth noting about all of this is dividend cuts. There have been cuts at these US ones. And so can I get past that? We talked about that a bit. Yes, I could probably get past that because these banks have reemerged new, and there's new regulations in place that should hopefully safeguard issues in the future. And for better or worse, the banks power the economy, and without the banks, there is no economy. And so the way I look at it is even if there is drama in the future, the government's going to figure it out with them. I don't want to say that's like a good thing. Certainly, I don't think it is. I'm all for prudent banks, prudent financial management. But that's just the world we live in now. We live in a levered world, and the banks create the leverage for everyone. One other thing, though, I want to mention here. I'm just looking at my notes. Warren Buffett. Warren Buffett has a big stake in Wells Fargo, very big. My understanding is he owns preferred shares as well. I have mixed feelings on Buffett. Sometimes I don't like investing when Buffett is doing certain things. Occidental Petroleum, for example, I won't go near it. I warned everyone, actually, and it's gone down much more since my video. I wouldn't get into it because of this whole Anadarko thing and Buffett financing it and getting huge interest rates, this and that. I don't really like investing along with Buffett in that kind of situation because I'm not. Buffett's doing something very different than I'm doing when he invests in Occidental. He's providing debt financing and he's getting a huge return on it that I just don't have the privilege of getting. When it comes to Wells Fargo, I haven't dug into it enough, but my understanding is Warren Buffett, it's kind of more like a Coca-Cola, which I also own. He's more of a long-term stakeholder. He's more of I'm in the game because I like the bank. I want to hold it for the long run. And so in that case, Buffett is more of your ally. He's more invested along with you. He's more invested with a similar long-term horizon. Whereas Anadarko, Kraft Heinz, for example, those are very different. In those cases, I don't want to be in it because of Buffett. In this case, do I want to be in it because of Buffett? Honestly, I'd feel better if he wasn't in it. But does it really bother me that Buffett is in it? Not enough to stay away from it, but it's something worth noting. And so I'd say generally it's a concern of mine, but it's not a huge deal breaker like it would be for Occidental or for Kraft Heinz. Why would I add Wells Fargo? Why would I do it when I already own Bank of Montreal? We already talked about this a lot, but I would say the biggest points are lower leverage than the Canadian bank that I have a huge dependence on. Traditional savings and loan focus, huge focus there. Best price to book of the bunch, so it's a value. And I would say it's the least efficient. There's some room to cut the fat. There's room to improve what they are doing. So the question becomes, quite frankly, going into this video, I'm still on the fence. Should I add a 44th position? Will I do it? Will I not do it? Cast your vote. I don't know what I'm going to do. I'll tell you right now. I need to sleep on it more. I've done all this analysis. I kind of gone through analysis paralysis. There's pros and cons. Like, why wouldn't I add it? Because of Buffett. Would it really materially change my position, my strategy? I have 44 positions instead of 43. Do I really need it? That's why I wouldn't add it. I'll tell you at the end of the day why I'm kind of leaning towards doing this. One of my subscribers and commentators, Steve, is going to love this. Shout out to my friend K97 as well. He's been asking for this video forever. He's one of my earliest subscribers, big supporters. Thank you, my friend. Same with you, Steve. Thank you for all your support. Bless you. We don't always agree, but I appreciate the support, the dialogue. So we're all different. We all have a different strategy. And that's what makes this stuff so exciting. But my friend K97, he's asking for this since the early days. I finally did the bank video. I hope it meets your expectations. I avoided it forever, but here's what it comes down to. For me, adding a new position is motivating. New year, new position, because when I add a new position, it gives me a reason to stop wasting money. It gives me a reason to focus. It gives me a reason to bring it to size, because when I have a small position in my portfolio, it's not up at size, meaning it's not up near 1% of the portfolio, it bothers me. And so it's just fun for me too to buy more stocks. And sometimes when I think of dividend investing, it's not only about which stocks you buy. It's not only about picking the best stocks. Surely you want... Let me rephrase that. By having fewer stocks, could my portfolio performance be better? Yes. Let's say I had 20 stocks instead of 43 or 44 if I had Wells. Yes. But that portfolio performance is already really good. I'm generally tracking the S&P, if not slightly beating it, with a much higher dividend focus, with much less risk, in my opinion, because of the dividend focus. But that's not all of it. Half the battle, if not more than half the battle in the stock market, in my opinion, is saving money and deploying money. By adding more positions, it allows me to be more excited about what I am doing. It allows me to save better. It allows me to invest more money. That's why I do it, quite frankly. And so, do I want to have 50 positions? Do I want to have 100 positions? No. Am I kind of at the point where to add more positions, I have to subtract? Probably. Am I going to subtract something right now? No. But am I going to think long and hard about it later this year when some of my stocks split into multiple companies and I have even more positions? Yes, I am. But at this point in time, early in the year, when I'm leaving the holiday season that quite frankly was pretty expensive on gifts, on lifestyle, let me tell you this. This is almost embarrassing to share here, but I got to be open with you all. I got to, because that's part of the thing here. That's part of it, quite frankly. This channel is all about motivation. And how do you motivate? You motivate by getting real, and you motivate by sharing your failures as well as your successes. And that's why I was honest from the beginning that I'm new to bank stocks. I'm no expert. I'm 20 plus years into this, and I'm just learning some of this basic stuff about bank stocks. Why am I learning about it now? For whatever reason, it's kind of finally clicked that I'm actually interested in it. I'm taking so many tangents here, but I got to say this because this is important. Why did I not look at bank stocks before? I wasn't interested in banks. I was just like, banks, that's boring. Why did I finally get interested in it? One day, like recently, I woke up and I just had an epiphany. I was like, you know what, Ian? These banks are your economy. Without the banks, there's nothing. And society literally will collapse. There could be chaos without these banks working. And then I start thinking, oh my gosh, the government has such a vested interest in them working. That's why the government bailed them out. That's why the government will always bail them out. That's why they will always be tied at the hip. And I started thinking about this and I was like, this is profound. Why didn't I think about this before? And then I started thinking, okay, I'm going to buy one of the big US banks. That was my logical sequence. And then I was like, okay, Now I have a reason to learn it. Now I have a reason to do the analysis. But that's just how my mind works. That's how things happen sometimes. I have to be passionate or interested in something to do the research. It's an art and a science. That's how it worked for me. That's why my buddy K97, I never looked at it before because I wasn't interested, but then I had the epiphany. But anyways, that's how I got interested in doing this analysis. All right, going back to my last point. I know I'm jumping around here. I literally had to get up, watch the video footage because I didn't remember where I was. But now I remember. Sharing my challenges as well. Why am I thinking about buying Wells Fargo? I was looking at my statements, my credit card statements for December. You're not going to believe this, but during the month of December, my family and I spent $400 at Starbucks. I'm not kidding you. And so this is, I love you, Starbucks, by the way. At least I'm a shareholder. At least I'm a shareholder. But I got to say, that's just Starbucks. And so I started looking at my finances late in the year, holiday season. I bet some of you can relate to this. I bet some of you cannot. But I just got to share it out there. I spent some money. Do I regret it? Absolutely not. I don't. You have one life to live. I live my best life. I enjoyed it. Holidays sometimes can be fun, but they can also be stressful. Starbucks is something that I enjoy, and it livened up the season, if you will. And quite frankly, it's an office space for me as well. So I look at it, hey, $400 for office space for a month. If I were to rent office space here in the Bay Area, you cannot get that for that price. And so that's another way to look at it. And a lot of that money was not just coffee. It was also lunches, like literally buying the snack pack and eating it for lunch. And so that being said, I look at that, I have an epiphany, and I'm like, new year, get back on track, start deploying money in the market, start being more frugal, bring in the reins, and I start looking macro level. Is adding this position really going to improve my results overall? Would I have better portfolio return? Maybe if I had 20 positions instead of 44? Maybe, but that's not my challenge. I'm a really good stock picker. The stocks I'm picking are fabulous, and Wells Fargo, in my opinion, is one of those. And so I start thinking, what's my bigger challenge as a person from a financial standpoint? It's the money side of things. It's the spending side of things. And so then I start thinking, this is a gateway for me to get more money in the market, get refocused, not waste money. Go for it, Ian. And so quite frankly, after I do all this talking, I'm going for it. I'm buying position 44. Let's just do this thug lifestyle, in it to win it. Going for Wells Fargo. I'm going to buy some Wells Fargo sometime soon. And I will keep adding to it to bring it to size throughout the year. It's close enough to my 4% yield threshold for the year. I'm only buying stocks that are yielding 4% or more. Maybe I'll make an exception for something like a 3M, for example, but that's where I am at. So I'll be buying this baby. And so thank you for sticking with me throughout the video today. I hope you enjoyed it. I hope you enjoyed some of the kind of real talk at the end as well. That's how I like to do it as a Thug Life investor. I hope you enjoy that. I hope, it helps shed some insight for you as well. Before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long Bank of Montreal, ticker symbol BMO, Bank of Hawaii, ticker symbol BOH, Chubb, ticker symbol CB. I will be initiating a position in Wells Fargo sometime soon, so I will be long, ticker symbol WFC. I am long Coca-Cola, ticker symbol KO. I am long Starbucks, ticker symbol SBUX, thank goodness. And I am long 3M, ticker symbol MMM. I own those stocks in my personal dividend stock portfolio. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here for fun and entertainment. There's probably mistakes in the analysis, but I'm doing my best to share my journey. Additional disclosures, disclaimers in the description below. The best gift you can give me for the new year is a like, thumbs up, subscription, comment. It means the world to me. I will see you all in the next dividend investing video, and make sure to share in the comments below what you think about the bank stocks. If you're an expert in the banking industry, share your thoughts. I'll see you all in the next one.